Hello everybody, this is the second part to the TPD series as requested, so I'm going to get right into it. As stated last time, past performances do not guarantee future results, so backtest what I'm saying, make sure you go into the charts and make sure that what I'm saying is true before you try to blindly take a trade off of it. So let's get into it. Firstly, what do you see? Now, pause the video, get yourself a pen and a paper because this is very important as this will be used throughout the entirety of this presentation. So what you see in the beginning of the video compared to what you see at the end, that is what is important. So write down what you see. I'll give you a second. All right, if you said precision swing point, then you would be correct. Now, amplified TPD, the wicks do the damage, the bodies tell the story. So liquidity dispersal theory, I want you to pay attention to the PSP shown right here. And I want you to focus on the bulk of the body. So the higher time frame narrative for this price run was bearish. So we were seeking lower prices. And as you can see, the asset that had the bulkiest up close candle showed the highest resistance to the downside. But the two that did not make that big of a bulky candle, especially the one to the right, made the least resistance. And the one in the middle was kind of like the middle guy that didn't do too high or didn't do too low resistance. And in the last video on the turtle soup secret, I stated that you want to trade the asset that is stronger and not weaker. So in weaker, I mean as a sense of the worst asset to trade. So if you look at the one to the very left, you can see that that one is quote unquote weaker. Doesn't matter if it's weaker to the upside or weaker to the downside, it's still the worst asset to try to frame a trade off of, and it will be the most highest of resistance to get to your target. Narrative alignment. All right, so I got a couple questions asking about narrative alignment and how to know if you're in the right direction, because as we know, TPDs can be used for continuations as well as reversals. So it is very important to be in the same direction as the higher time frame institutional order flow, and we can gauge that by using a higher time frame SMT combined with the TPD. So as you know already, if you have a daily time frame TPD, then you want to see a weekly cycle SMT. And if you have a 4-hour TPD, then you want to see a daily cycle SMT. But to add on to that for extra confirmation on narrative and how to know if you're in the correct direction is for a daily time frame TPD, you want to have a monthly cycle SSMT on top of that. So if you have a monthly cycle SMT and then a daily time frame TPD, with a weekly cycle SSMT, there's a high chance you will be alongside order flow. If you have a weekly cycle SSMT and then an 4-hour time frame TPD on top of that, with a daily cycle SSMT, then there is a high probability that you are in the correct order flow. So watch that as many times as you need to, but that is very important because the narrative is extremely important for this because, as I stated already, TPDs can be used for continuations and reversals, and we're going to show an example later on with continuations. All right, 1 + 2 = 3. How to know when candle 3 will not make an SMT. So if you look closely, you will see that after we had our PSP form, candle number 3 made failure swings on all of the assets. None of them turtle souped candle number 2. And the reason this happened is because there was already a predefined SMT that started the buy program. That's not to get confused with a buy model. A buy program is whenever, or any program, buy or sell program, is whenever price runs quickly in one direction and usually offers 1 to 2 fair value gap entries. And on candle number 3, whenever you have that predefined SMT, generally you can use candle 2 as a means of premium and discount, and you want to buy below the opening price of candle 3 along with buying below the equilibrium of candle number 2. So using candle number 2 as an entire range, you can buy at or below the 50% point. And if you look, all of the assets did that. The PD array matrix, the fractals of candles. So on a higher time frame outlook, once you have that TPD that is already defined and already confirmed by an higher time frame SMT, so you have, for example, the monthly SSMT and then the daily TPD and then the weekly SSMT afterward. Once you have all of that in conjunction, you're probably wondering, okay, well, how do I get in sync? How do I actually enter in these trades? Well, this is where the PD array matrix comes into play. So on the higher time frame outlook, it'll look just like a normal candle, but if you look deeper inside, you will have PD arrays that you can look to enter off of, either above the 50% point, which would be premium if you're bearish, or below the 50% point, which would be discount if you're bullish. And don't worry, I'm going to show an example later on using this, and this is how I caught the weekly expansion on the S&P this week. Well, it would be last week whenever y'all are seeing this. But within the higher time frame candles, there are lower time frame entry patterns. But we don't trade patterns, but entry techniques. And if you backtest this, you will see it. Utilizing TPD premium and discount wicks. So as we can see, candle number 2 created a TPD on all of the assets, along with candle number 3. So the asset that is the weakest typically makes the deepest retracement, and the asset that is the strongest makes the quickest takeoff. So that is why I traded the S&P, which is in the middle, and the NASDAQ is the one to the very left, and the Dow is the one to the very right. So if you look at candle number 2, you can see the NASDAQ made the weakest candle, but the S&P made a relatively strong candle, and the Dow on the very right made a strong candle as well. But you're probably wondering, okay, why didn't the Dow take off? Because that one made the strongest candle. Well, if candle number 3 is a PSP as well, it'll follow or kind of shift gears and disperse liquidity into whatever candle number 3 did. So if you compare candle number 3 on all of the assets, before price took off, the Dow made the weakest, and the NASDAQ on the very left made the strongest, while the S&P made the middle. Generally speaking, the S&P typically always stays within the middle, and Dow is usually the kind of slow moving asset, and the NASDAQ is the quicker takeoff one. But utilizing the premium and discount wicks, the candle after the TPD, because now you've already been introduced to the fact that there are many candles in the sequence. It's not just 3. There are multiple you can use. So whenever candle number 3 is also a TPD, it will usually be a continuation of candle number 2. And on candle number 4, you can use the same approach to buying below candle number 4 and buying below the 50% point of candle number 3's wick, which you can see right here. All of the assets traded below the 50% point of candle number 3's wick, and then boom, price took off really quick, except for the Dow, because that one was the weakest and the worst one to trade. So that's kind of ties in back with liquidity dispersal theory. So if there's another PSP that shows itself after the original TPD has already been set in place, then liquidity will shift gears to whatever the closing price was of candle number 3, and then candle number 4, you can use that for an entry as well, trading the strongest pair. ES, weekly expansion trade review. So this is a review on the trade that I took, and this is not hindsight as it was called beforehand on Twitter. If you want to go look for yourself, you can do a little bit of digging for that. But this is exactly how I got to the conclusion of being able to catch that entire up move that was formed last week. So as you can see, we have the E-mini S&P on the left and the Dow on the right. Both of them had hit their respective higher time frame levels, which gave me the narrative of higher prices. So the S&P hit a higher time frame fair value gap, and the Dow hit a rejection block. Now, bringing the NASDAQ into this, as you can see, whenever price had hit those higher time frame levels for the S&P and the Dow, we had created an SMT on that higher time frame level with a TPD. So that was my confirmation for higher pricing for the narrative. Now, looking at the hourly time frame on the S&P, that red shaded area is the buy program activation. So once we got that break of structure on the hourly time frame, that is how I knew, okay, it is a go time. It is time to look for a buy. And as you can see, within that range, we had a breaker and a liquidity void. So whenever price returned into it the first time, since I do not trade Mondays, I kind of let it do its thing, and then I saw that candle number 3 formed a PSP as well, so that gave me confirmation that Tuesday I could look for a long scenario. And as you can see, we traded back inside of that breaker, and I'm going to zoom in on this shaded area of price action right here. And as you can see, inside of that area, we had a daily SSMT with a 15-minute TPD. So that was the confirmation to enter in and then have my stop loss set below previous day's low and allow it to ride out for the previous month's cycle's high, allowing runners and then holding till NFP Friday and then closing on Friday. All right, the power of none, hourly quarterly alignment. So if you have an hourly TPD on the 8 a.m. candle, you want to look for a 90-minute cycle sequential SMT during the 9 a.m. candle, looking back on the 8 a.m. candle. So we're moving from the hourly time frame to the 5-minute time frame, and this is just the fractal version of what I shared with you for the 6 a.m. candle, and you can use this in conjunction with one another for an extremely high probability setup, which I'm going to show you in a moment. Now, only focus with this for the 9 o'clock looking back on the 8 o'clock, because in the last lecture I said that you can do something for the PM session and you can do something for the Asia, but none of you focused on what I wanted you to focus on, which was the 6 a.m. candle. And it is very important that you focus on what I tell you to focus on because it allows for the highest degree of probability. So my personal approach, one setup for life. For the gentleman on Twitter that kept posting this, thinking that he knew everything about this that there was to know, you don't, and I know you're going to be watching this, so you know who you are. For the one setup for life, you've seen this before. Now, I left out a couple of things. So, utilizing the 4-hour TPD combined with the 1-hour TPD, it gives you a nice little model that rarely fails if you use it correctly. So utilizing the 6 o'clock opening price and the 9 o'clock opening price, you can find very high probability setups with a 2-stage SMT. So for the daily cycle sequential SMT, if nothing is shown for the same triad that you're trading, you can use intermarket SSMT, and my personal favorite is using the stocks, which would be the futures, so the S&P, NASDAQ, and Dow, using the futures triad in conjunction with the bond triad for the 15-minute time frame looking at the daily cycle. Now, for the 90-minute cycle SSMT on the 9 o'clock candle, I really like to use the same triad. So you're bringing in an intermarket SSMT combined with a normal SSMT combined with the higher time frame narrative, and everything is just in alignment. If you do this properly, this model rarely fails. And if you have a higher time frame PD rate on top of that, it's over with. So looking at an example right here, we have the 2 a.m. TPD, and focusing on the bulk of the bodies, we can see that Dow is the one that tipped its hand saying, I'm going to make the deeper retracement, while the ES on the left was the one that kind of stayed stagnant. So looking at a closer time frame, we can see that the Dow made the lower low, creating the daily cycle SSMT while the S&P on the left made the failure swing below the 6 o'clock opening. And now you're probably saying, well, the 10 o'clock candle opened up already, and wouldn't we want to focus on the 10 a.m. candle? Yes, you would be correct if you wondered that. So the 10 o'clock candle, if that opens and nothing else has tipped its hand, you still want to focus on the 6 o'clock opening for the 4 hour, along with bringing in the 10 o'clock opening into the equation. So buy below the 6 and the 10, or sell above the 6 and the 10. That is very important as well. And also the 9 o'clock candle opening. There's a reason I haven't really shown many visual representations, is because I know there's a high chance that this video might get leaked somewhere. And unless you've been following along with the previous video and with this entire mentorship as a whole, you're not really going to understand what's being shown, which is good, because you guys are going to be the only people that are able to see these things, and there isn't some asshat on Twitter trying to leak stuff and then claim it as his own. So bringing NASDAQ into the equation, we already had our daily cycle SSMT with the S&P and the Dow. Now, bringing it in to an even lower time frame perspective, which would be the 90-minute cycle sequential SMT, as you can see, that is exactly what formed. So we have a two-stage setup, and if you go into the chart and backtest this, you will see a new week opening gap where the S&P made the turtle soup. So that is even higher probability. And then you can see after the buy program initiated, there was another opportunity inside of the BPR fair value gap entry in that gray shaded area. So this is a two-stage setup combined with a 4-hour TPD combined with a higher time frame narrative. So this is exactly what I would have traded to get in sync with a higher time frame order flow if I wouldn't have gotten a trade on Tuesday. So this was last Wednesday's price action. And that is my one setup for life, that later in this year you're going to see some crazy stuff of me using this setup, because I have some plans later on in the year utilizing this exact model right here. All right, supplementary psychology. So emotions are constantly affecting our thought processes and decisions. The most common is the desire for pleasure and the avoidance of pain. So the only reason you experience greed is for the desire of pleasure. The only reason you experience fear is the avoidance of pain. Only reason you experience impulsiveness is the desire for pleasure. And the only reason you experience FOMO is for the avoidance of pain. Once you understand that all of these things play a part with your trading and why they're happening and why they're going on, you learn how to think rationally instead of irrationally and following along with what your emotions are saying. So in this game, you want to have a emotionless thought process. You do not want any of these things shown on the screen to affect your decision making. And that is extremely, extremely, extremely important. Because if you allow these things to manifest themselves into your trading, you will notice your results will significantly decrease, and your decision-making process will not be as sharp as it needs to be. So that will be it for this video. Hope you got something out of it. I'll set a high mark, since y'all did very, very, very well with the last video. I'll say 200 reactions, and we can get a part 3 to this series. So if this video can get 200 reactions, then a part 3 will be on the way, because this is still not everything. This stuff goes deep, very, very, very deep. So that will be all. Again, I hope you guys that watched this found something useful out of this, and I will catch you guys maybe in the next one.